Welcome to Retail Retold, the stories behind how that store landed in your neighborhood. I'm Chris Ressa, in conversation with the people and stories shaping retail and real estate. Brought to you by DLC.
Welcome, everybody, to this week's episode of Retail Retold. I am not your regular host, Chris Ressa. I'm Adam Ifshin. I'm the founder and CEO of DLC Management, and we're thrilled to have you for our inaugural episode in our new podcast studio here at our headquarters in lovely Westchester County, New York. Today for you, we have an extremely special guest, our partner in our co-GP fund venture, Bruce Cohen, who is himself the founder and the co-CEO of Temerity Strategic Partners in Chicago. Welcome, Bruce.
Thank you for having me here.
So everyone in the investment industry is going to get a little inside example of what my wife says is, are you on the phone with Bruce again? And the answer is yes, I am on the phone with Bruce again. But today we're live in person. So thank you, first of all, for coming and taking the time out of your extremely busy day, time, your fundraising, everything else, to join us here for our inaugural episode. And I think since many of our listeners are more in the retail world, I think we start sort of a little bit at the beginning, which is you've got a long career. You've done a lot of different things in commercial real estate. So why don't you give the audience a sort of short form, your own 60, 90-second bio of yourself and a little bit about your origin story in real estate?
Well, we have this unusual bifurcation in our industry between operator and capital. And I've been on the capital side my whole career. And for a period of time, there were opportunities on the capital side to create differentiation, identify ways to meet a capital need that hadn't otherwise been done. But soon capital became omniscient. Capital is everywhere. It grew. And over time, my big epiphany is like, wow, when the capital is so flush, so sophisticated, a market loses its inefficiency. And so it's hard to generate outside returns on the capital side. And so my big epiphany was, wow, is there an opportunity on the operator side to meet a capital need that's unmet? And that's how we ended up going from 25, 30 years on the capital side to now being a support function to folks like yourselves who are really the ones creating value at the property level.
When you first started you're one of the first serial entrepreneurs in commercial real estate on, as you describe it, the capital side. There are plenty of serial developers, serial by necessity because of the ups and downs and the vicissitudes of being a developer and being an owner. But on the capital side, that's much less a frequent occurrence. And you've done lots of different things, both inside of other organizations and your own organizations in the capital raising side. And a few years ago, you made a pivot and you decided to launch Temerity. Why don't you give the audience a little sense of what was your thought process about why did you want to start yet another business? You had already sold, built, sold successfully several other platforms, including to some of the biggest names in the industry. And you had worked inside on capital raising for some of the biggest names in the industry, including Cortland in the multifamily space and Sterling Bay in the mixed-use space. So what made you decide to A, do it again, and B, do what you're doing now with Temerity?
Well, let me give you a couple of answers to that. First is the original business plan that we started in the early 90s was we were focused on industrial and credit. Those were the two areas that we thought were inefficient, scalable, not cycle durable, which meant it wasn't point in time, and it had a barren competitive landscape. So we built businesses around both of those strategies. The industrial business we sold to Blackstone and the credit business we sold to Ares. So it was really when I went inside of Ares that I realized that when you're an entrepreneur, you can innovate and you can then execute, and people follow you because they have to. When you're in a big company, you discover that it's very hard to innovate and even harder to execute because then your business is about getting other people on board. And by definition, innovation means that it's an idea that not yet everybody has embraced. And so it's challenging to do that inside of a place. And so ultimately, my big epiphany was when I left Ares, I wanted to focus on the operator side and tried to figure out we knew what the capital needs of the operators were, which we'll talk a little bit about. Right,
More.
exactly.
That's the answer.
That's exactly right. And so the question was, how could we meet the capital needs of an operator in a manner that hadn't otherwise been done? And when I started, in fact, the capital strategy we had failed because it was too complicated. And I should note, I started Temerity with my close friend and longstanding partner, Jeff Citron. Jeff started real estate at Cerberus and then left and set up Square Mile Capital, and like me, had been an innovator in the capital space. But he used to talk to me about simplicity, and I don't really function in simplicity. So the original product that we had, and I was partnering with his company at the time, it was too complex. And so as you noted, I ended up joining Cortland, one of the firms to whom we had gone to propose capital, initially on their board and then as an advisor and then ultimately as a senior partner with the firm. And again, I found that this was such an unbelievable business, but innovation was challenging because you had to move people into doing something they hadn't otherwise done. And so in 2022, when my partner Jeff he had sold his company, he was now investing his own capital. It was on this kind of growth capital to operator strategy we're pursuing now. And he came to me and said, let's do this. I was pretty enthusiastic because, again, it was an opportunity to innovate, build our own platform, and generally think, if there is an opportunity, let's go figure out how to go take it. Let's go figure out how to pursue that. It's very hard to do that in a big company. The good news is you have resources. The bad news, you have to move resources, and that's friction. When you're in an entrepreneurial environment, you have the ability to lock arms with your teammates and go take the mountain together.
So in doing that, starting in mid-22, right? You were certainly not the only potential provider of GP capital out there. And you and I both know many, many groups who've had all sorts of bespoke and programmatic GP investments in them or, into other firms as part of it. What did you and Jeff set out to do to differentiate Temerity, given that you were although you were both immense, high quality, highly ethical reputations in the industry and a long record of success, right? I mean, between the three of you had sold to Blackstone, Ares, and Affinius. I mean, there's a worse lineup of people to sell your businesses to. But what did you do to set out to differentiate yourself in what was a fairly disrupted time, right? Where post-pandemic, not exactly the greatest time to raise capital. How did you set that up, and how do you think about that?
So let's start with what the business opportunity is, and then let's start with how we thought about approaching the business opportunity, and then we'll get to what our product was and how to differentiate ourselves. So the business opportunity that we saw was that operators can find capital to be their joint venture partners if you're at scale and if you have competitive advantage and if you're really good. You have the opportunity to scale your business, but you need capital to do so. You need capital for pursuit and pre-development costs. You need capital to build out your operation, your organization. You need capital for guarantees and general liquidity. And then there's this big co-investment obligation, which is really sizable for a lot of operators. So for 10 years, we've been trying to figure out what's the right product to offer to operators. And what we realize is what makes an operator successful is that they build businesses and that they're entrepreneurial themselves and that they aren't really employees. They're people who are accustomed to making their own decisions, executing, And they're not looking for complexity, and oftentimes they're accustomed to capital that kind of tells them how to do their business. And my big epiphany is that capital doesn't understand your business. Why would we tell you how to do your business? And so our approach was, let's think about how to support great entrepreneurs by not telling them what to do. Let's help them on things that maybe they're not thinking about, which is organizational design, compensation, data, and how to use data to create competitive advantage, how to capitalize themselves in an array of different fashions, and most particularly, how to grow a business successfully. You being the poster child of somebody who's grown a business successfully over time means you don't need us to show you how to do that from 0 to 10. But if we can be instrumental in supporting your effort to go from 10 to 100 by bringing perspective and insights to bear beyond the capital we would provide, that would create a competitive advantage. So that was the big catalyst. First was, let's figure out which operators have great businesses, which operators have competitive advantage, which operators generate alpha. And then let's figure out how to have a simplified capital product, which we've designed around what we think operators want and eliminate the elements that operators abhor. And then let's be uber respectful of how good the operators that we back are. Let's recognize that they've got really successful businesses, and let's figure out how to respectfully add value to them in a manner that they embrace rather than we impose. So it started with the opportunity, and then it became let's pick the right platforms, and then it became let's figure out how to help them grow and support their activities. Let's bring all of our resources and relationships to bear. And to a degree, the capital product, what the price and terms and structure, becomes secondary to everything else we're trying to bring to bear. Because we're helping firms be great who are otherwise devoted to being great.
Well, I've had a chance to meet a number of the other partners, some of whom I had known before and some of whom I hadn't. And it's certainly the care and due diligence that you and your team have brought to thinking about who, what spaces, size, scale, scope, quality has all been fascinating. We went through our own long-term examination, but getting to communicate with other people in the ecosystem you're building, I think, has been one of the unexpected, added benefits, if you will. But so I think what you've just covered is an excellent time for us to pivot a little bit to sort of the how we ended up partners from your perspective. And it's fairly well known. I've spoken on other podcasts in the press. I've reminded you, your wife, your children, that I was not in the market for another partner. But why don't you tell everybody a little bit about, why you thought open air retail was a place you wanted to allocate capital, and then how you came to say that you wanted to do this with DLC.
Well, first of all, it's actually quite interesting because for 15 years we would tell investors, and when I say investors, I'm talking pension funds, insurance companies, we would say, you talk to research people and you read research, and many of your very sophisticated managers of capital or allocators do research and tell you where you should invest. Our view is bring all those operators in. Bring the people who are effectively touching the property and the users of the space in, because they tell you what their world's like. And if you get out and speak to enough operators, you'll develop an intuitive sense of the relationship between supply and demand for space in their property types and in their markets. If you talk to them in the balance of the capital markets, you know where liquidity is and where capital wants to go. And so that's been a big part of our business model. Our business model has been doing a bit of top-down analysis to figure out where we find markets that have properties and markets that have strong fundamentals and then we get in front of as many operators as we possibly can. So we've actually reached out to over about 600 firms. When I say operators, I'm talking about people who are literally touching the real estate, touching the tenants or the residents or the guests, depending upon the
Okay, so hold that
property
thought
type.
for 1 second, just so, because I know it, but I don't think other people can appreciate the 600 number you just put on the table here, right? So you've talked to 600 firms across all product types domestically in the United States.
And let me be clear, we reached out to 600, and we've now had conversations with 290. And that's important because all of these operators are of scale, all north of $500 million. They're all people with some track record and recognition. And so, first and foremost, curious as to why the 300 wouldn't want to talk to people to hear what else is going on. So we actually put, as part of our value proposition, we want to understand the intellectual curiosity of the people that we're backing. So it's telling to us the 285 with whom we have a meeting. And then with those 285 in every imaginable property type and market, we're trying to measure what the strength of demand is relative to supply.
Of the capital, you mean?
Of the fundamental relationship between the supply and demand for the space in the property type they occupy.
So in other words, what's going on the ground granularly in multifamily, in logistics, in self-storage, in retail, in office, et cetera.
Exactly.
Okay. But finish the funnel for people. 600 at the top, at the widest point, 290.
Yep.
How many partners?
And then we've now closed on 9 commitments, including our re-up with you.
Okay.
We'll close on a 10th shortly.
Okay.
So it's a lengthy process, and our view is that we try to figure out in a particular property type and in a particular market, where do we find the most relative strength in terms of fundamentals? Where do we see institutional liquidity the strongest? And then we try to figure out which operator has a universe of attributes that we find compelling. And let me hit pause and mention the following. Our basic underlying theme is that this has moved to the last 10, 15 years before in 2022 when interest rates grew. Most of the money made in real estate was attributable to declining interest rates and increased rotation of capital into our sector. And so
spread investing, effectively.
It was spread investing, and it became less about generating increases in NOI and more multiple expansion, to use a stock analogy. In our case, it was falling cap rates, which led to the same income stream being worth more. So many of the people's returns were generated not as a result of growing cash flow, but as a result of the capital flows. Since 2022, when interest rates moved precipitously, and you now have a situation where it's challenging to buy assets with positive leverage, namely the cash flow exceeding the cost of debt, the reality is this is now a business where somebody has to grow cash flow. And for a lot of folks, that's challenging because you have to develop conviction about how cash flow is going to grow and who will be able to grow that cash flow.
Well, and having a best-in-class team, right? Like you can't get lucky if you have to grow cash flow in a highly competitive, even a supply and demand balanced space, let alone what's going on today in some spaces where, right, there's a supply and demand imbalance to the detriment of the owner of the real estate.
So what happened with us through this process is a couple of things jumped out at us. One is, where's demand still robust? And two, where has supply been slowed?
Hi.
Correct. So almost every imaginable property type had an overwhelming amount of supply delivered and demand fell off a cliff. Pick your property type. Office, industrial, self-storage, almost every imaginable multifamily, almost every imaginable property type had this delivery of a massive amount of supply, demand falls off a cliff, interest rates go up, there is essentially a 20 to 30% reduction in value because of capital costs and capital flows, and that's before you experience poor fundamentals. So it didn't take long to realize retail is pretty darn compelling. First and foremost, and frankly, some of this I learned from you. And so,
Memo to file for any aspiring GPs out there and people who want to start their own real estate ownership business. If you can find a GP partner who can talk your own book, do it.
So, well, and frankly, how many capital folks start from the premise that we learn from you? And so how much...
Far fewer than I think it might be.
So we learned working with Chris Ressa and EJ and walking these buildings and seeing how they see the opportunity. And I'll come back to why retail became so compelling. But we all of a sudden discovered, wait, your supply has been shut off for some period of time. And then we realized, oh, you mean the internet didn't wipe out physical real estate, retail real estate? Oh, you mean this retail is a tool to acquire customers and distribute product? There was so many elements of the demand we didn't understand that you and others in your space educated us. And so we were motivated in part as we learned more just because the fundamentals were so strong. And then you had this dynamic where interest rates moved from being less than the cap rate in all of the property types to being at or above the cap rate of most real estate property types, which meant all of a sudden I can't get positive cash flow. Retail still was trading at cap rates above the debt cost. So in an environment where people were prioritizing cash flow, all of a sudden we're realizing, wow, you've got great fundamentals, you have positive leverage, you still experience 20 to 30% value diminution because of cost of capital, but you had all of these fundamental attributes. So to us, it was all about who can we find who can increase cash flow. And then we can talk about how that happens because we learned a lot from you guys.
Well, let's talk about that road a little bit because I think people will find this interesting. We'll fast forward here just a tad. So you have your thesis, you're convicted. We want to put a retail operator in the TSP stable or ecosystem early on in our journey, and you go out and you talk to a bunch of operators that didn't include us. Why don't you tell everybody what happened then?
Well, the big thing for us that we're always trying to understand is, first of all, the people think growth capital is something that you want to make available for emerging operators, smaller firms.
And this is where, that had been the lion's share of the GP fund investment thesis for years.
Correct. And our basic thesis, because my partner and I had backed two firms that have since gotten to scale and industry leadership. But for the first 10 years, it was very challenging. So our big epiphany is there is competitive advantage at scale. We want to work with folks of scale. So that was the first thing we started with. The second thing we started with is who knows the customer better than someone else, and who knows the physical plant better than somebody else. And so we then tried to figure out in retail who knows the tenants the best. Who knows the tenants that we think will have the best performance in this environment? So what we found in the DLC team was, first of all, 34 years of experience covering a static universe of properties, which meant not just you, but most of the folks in the company had seen every property in the country. It was let me tell you about that property. Let me tell you about the tenants. Let me tell you about the rents. And then most importantly, let me tell you what the rent opportunity was. And we're like, what is that? And they're like, well, if I can get that space back, I can actually lease it for 2 or 3 times. And we're like, what do you mean? In the capital side, vacancy is scary. You don't want to get space back. And the biggest problem with retail is capital thought it was a credit business, that I'm buying all of these fabulous credits and I'm just going to put it away and carry it for a long period of time. And then capital discovered, wait a second, these credits decline, they get themselves in trouble, and all of a sudden you overpaid for a physical plant. Now we sit with DLC and we discover that I want that space back. And we thought that you want long walts, right? Weighted average lease terms. And Adam educates us that short walt is the opportunity in the space. And we're like, what does that mean? It's like, I know if I can get that space back, I can release it. That then starts to hit this notion of, well, how can you move cash flow? I can move cash flow if I've got below market leases. That's when we realize that everybody was missing the opportunity in retail, because if you were in property types that had robust demand for the space and you could partner with someone who understood what the space would release for, those people are going to generate enormous returns for their investors. And that was the catalyst for us saying, this is a really interesting platform. Let's learn more.
Right. Then there was just one problem.
Well, I mean, you weren't that interested in our capital, but we get that a lot. You know, one of the questions you and I talk about oftentimes of being an entrepreneur is first you have to believe without seeing, and then you have to convince people to trust you to either, in our case, provide you capital, or in our case with you, take our capital. And so a lot of that is trying to be relentless. And you know we can be relentless when we're trying to make our case. But we also had to articulate to you how we could add value to you beyond money. And that gets to the underlying framework of our partnership, which frankly goes to, I believe, the underlying nature of your partnership with your DLC associates. That to us is a tell. And maybe we can talk a little bit about what we learned as we started to dig in.
Well,
here.
of course, there's you guys said you and I had been talking, mostly you had been talking and I had been avoiding. And then, of course, you cornered me into a lunch in Toronto, Canada, of all places. And then you said, well, let me at least come meet the team. So I did invite you here, and you came with a whole bunch of people. And what'd you think about that experience?
So, as you know, we have a rating system. We got a whole bunch of University of Chicago Booth graduates in our place, so we try to convert everything into analytics. And we've rated the 285 operators that we have interacted with. And we talk a lot about it with investors, because what we're going to see in this environment, if yesterday's environment was beta because returns were attributable to capital flows, today's environment is alpha, which is, can somebody do something that generates outperformance relative to their peers? So in our rating system, we have some kind of quantitative tools that we ask ourselves, do they have focus? Do they have an infrastructure? Do they have a track record? And we probably spend the most amount of our time on qualitative elements. Qualitative elements is, have they built out their infrastructure? How does the team work with one another? How do they work together? What's the relationship between leadership and the next generation? Is there a commitment to the next generation? So it's a lot about how the leadership leads and how the team responds. So for us coming in, you did not tell anybody why they were there. You invited us to ask questions and advise your team to, to answer transparently and honestly, which is an anomaly, because oftentimes strong-minded CEOs curate everything.
Are you suggesting I'm a strong-minded CEO?
I was just making the analogy to others. But there was, through the course of this, an expectation that there would be a curation. And there was none of that. And there was a familiarity and a comfort and a trust. And most particularly, there was a universe of people in the room who were very different personalities. So your partner, Mr. Wigzer, who we have such respect for, was like ballast to you. And so part of it was watching the two of you work together, and then realizing you guys have been together 25 years. You went to college together. So you had both a long-standing relationship but a professional relationship. There was a woman by the name of Anya in the room who happened to be related to you, but you didn't really understand she was related to you until we left and realized, was that his daughter? And all of a sudden we realized, oh, this senior professional person in the organization who's just like everybody else, she's obviously earned respect, happens to be part of your family. So one of the things that we worry about is family businesses, which oftentimes work with an idiosyncratic nature, but we have enormous praise and pride in firms that operate as if they're a family. Then you have trust and confidence, and that can be transformative in performance, as evidenced by when we did 30 reference checks of you, including all of your capital partners and many of your tenants. They spoke about they saw the same types of attributes that we saw, and it then became clear to us this is like endemic to who you are. And those are very much parts of the process that we go through when we're measuring the operators we're looking to back.
Look, we've tried to chart our own course about a lot of the things you're talking about, many of which I talk about and think about as just the principles of how you want to live your life. As an entrepreneur, there's not a lot of time in my life, awake time, that isn't about the business. And I've said for years and years and years, and I think it's true that we don't have employees here. We have teammates. You either get drafted on the team or you get signed as a free agent. But first and foremost, we want to make sure you're a cultural fit with the team. But we were, I will say this, we were very clear. We wanted our team to have an unvarnished look at you and your team very early on, because their view mattered. For a very long time, if they needed capital, they came to my office on the GP side to do something. They came to my office, and the answer would, they knew what they were dealing with, and like, oh, now there's potentially going to be this other thing. So they had to have, from my perspective, from Jonathan's perspective, Chris's perspective, Anya, et cetera, they had to be comfortable just as much as I had to be comfortable. And I agree with you. It's a conversation for another time. It's far outside the scope of the time we have today. But the interplay between trying to build a culture at a business that also is in some way, shape, or form a family business in our industry is unfortunately littered with not great outcomes.
Right.
And spending the time to be a historian of those outcomes to try and figure out how to do it differently is something I've spent a lot of time on. So let's move forward a little bit now, and let's look a little bit to the future before we wrap up today. I want to think about a couple of things. First of all, you've met with 290 groups, plus your own historic experience, Jeff's experience. Your partner's now about to be with 9 firms, right? Because we're the repeat.
Right.
If you were to set out and say to a budding GP in the real estate space, what are 3 areas where if you can really get really, really good, those are 3 areas that ultimately, in your view, determine that you're on the road to being a best-in-class GP? What are those 3 things you would encourage people to work on and build on? When you see successful GPs, what are those 3 things?
First and foremost, I think you have to be honest with yourself about your edge. Where is your competitive advantage? I think a lot of people in our business view their competitive advantage as being deal people.
Mm-hmm.
And our view is that the best operators have figured out how to have edge in either leasing, construction, but most importantly, it's with the people who use their space. So if it's a residential operator, it's somebody who just understands how they meet the needs of their residents. If it's retail, it's understanding the retailers better than somebody else. That's a big part of why we partnered with you. In the industrial space, you have to be wired into the industrial users and the brokers. The brokers are a key part. So in each sector, you have to ask yourself, do you have competitive advantage fundamentally in growing cash flows, because that's our business. The operator grows cash flow. Everybody talks about sourcing. There's an element to that, but ultimately it's about execution. That's thing number one. Thing number two is you have to build an organization, because this is going to become increasingly a scale business. So as fabulous as entrepreneurial deal people are, they will be only as good as their ability to get to scale, which they can't do themselves. So like what you've successfully done is you've organized a business that can do an array of processes associated with owning, operating real estate and creating value in a seamless fashion. And that means you go from being a deal person to running a real business. And then lastly, we're looking for aspiration. We're looking for people who think about the opportunity to grow their business. Going back to the family thing, we oftentimes ask ourselves, does that person have a lifestyle business or a shareholder business? People are like, what does that mean? And we're like, a lifestyle business is you make plenty of money, you like going into the office, it's fun, and that's what governs you. A shareholder business is you're building something that outlasts you. And you and I have talked often about your vision of this being a sustainable company well beyond your days. That is really where we become intrigued, because if the organization can create edge and competitive advantage, if they build systems and processes and people that allow them to create that and sustain that competitive advantage, and if they're aspirational, then our capital, our resources and relationships help them achieve their objectives, rather than us forcing them to have the aspiration to achieve our objectives. We're much better off being a support function to you achieving your objectives.
So how do you think about that? And I'm going to turn the tables on you a little bit, a little off script. So you and Jeff are roughly contemporaries of Jonathan and I. Jeff may have a few years on us. How do you think about that in the context of your business, which is earlier in its development? And I think it's a fair question, right? If you're going to enter into a long-term co-GP relationship, and I know exactly how long you intend to work. It's exactly how long I intend to work. But how do you think about that in the context of your own business, the lifestyle versus shareholder part?
So, you get to a point in your career where you've been fortunate and you're in a good place, and then you start over again. Well, why do you do that? You do that because you're doing something interesting, and because you can surround yourself with people who are younger and more energetic and more ambitious than you are, that they want to take the mountain beyond you. And so today, I have a universe of people, we're taking the mountain together. There's a point in time where they're taking the mountain ahead of me. And that's fun. It's fun having a young group of people. What transformed our business? Josh Livingstone, Tim Thomas, Mitch Fenberg, Jennifer Perkins, Olivia Benjamin, Carrie Oser. These are young people coming into our business and believing without seeing, partnering with us to partner with you, advocating for a strategy and a business model that doesn't exist. And all of a sudden, it's exciting. And there's, all of a sudden, those people become your oxygen. So for me, this next generation is what it's all about.
Well, I think I think that's actually one of the key things. That's why I asked the question that gave me a level of interest that I didn't have previously about not only taking a GP partner, but taking, deciding to do this with you and Jeff and Josh. And obviously, we don't work with Mitch as much, but Tim has become, he's half part of the DLC family, whether you like it or not. But I guess that sort of leads to the sort of the crazy sort of elephant in the room, right? Which is that you and I knew of each other for a very long time, and essentially did not know each other at all before late 2022, early 2023. And by the way, just as an aside for everybody listening out there, if you think that one of these happens, like, you elope and this gets done, in a weekend, Bruce and I will dissuade you of that. This is a full courtship, engagement, pre-wedding drama, closing.
Exactly.
But we can talk about that at another time. But I think I would be remiss if we didn't talk a little bit about the separated at birth thing, right? Our wives have a view about this now. They did not know each other at all until after we had made this partnership. But I think one of the true amazing, unexpected outcomes of this is learning about each other in a way in which it does feel to some degree like we might have been separated at birth. So you can give your side of that if you so desire.
I don't know if this is specific to real estate, but I often talk about it specific to real estate. My partner, Jeff Citron, and I have been partners since 1993. And we never worked together, but we worked in different places, but as partners. So I was an investor with him. He was an investor with me. He was on my board. And our wives are friends, and we're close over a long period of time. That's what makes our business fun. And part of this is you get to a point in your life where you say, I want to work with people I like being around. And the relationships then spur the partnership, and the partnership spurs the relationship. And so a big part of this was us developing a friendship, which makes this so much more fun because we have had great success, largely because of you and the DLC team. But a lot of it is because of the relationship. And it's probably inappropriate for this podcast, but I tell everybody that, you and your beautiful wife coming out and spending a weekend at our place in Colorado, where you would come up into the kitchen at 5 a.m, get a cup of coffee for your wife, bring it back down for her, and then you and I would talk about every imaginable topic. And then we would keep doing that throughout the day and then late at night. That makes a business partnership a real partnership. And that's what's made this, I think, so fun for us. And it's why we get a hall pass from our wives for talking all the time, because it's on the weekends and it's at night. And they're all, at least in my case, my wife is wondering, who are you talking to? And it's Adam. So she's now reconciled herself to it. But I think that's what makes our business fun. And I think that's why this partnership will evolve, and it'll take on new directions, and we'll build new things together. And that's when this really works, brings me back to what you started with, which is this, quote, growth equity GP capital solution that we're providing. If it's just a deal, then you can get a deal anywhere. If we can have it be something vastly more substantive, it'll be more powerful, it'll be more effective, we'll help you grow your business, we'll be the beneficiary of your growth. And then generally we'll be like, I'm just going to keep doing this for 10, 15, 20 years, even though when other people are saying, what the hell are you doing? It's because this is really what makes it fun.
Well, thank you. That's nice of you to say. The reality is we did probably speak 18 or 20 hours a day up in the mountains. And our wives had never met before, so God bless them for putting up with us. I will say that those intangibles, which are obviously nothing we ever could have known when we entered into the relationship, while they don't, at least for us, they don't define the why, they certainly become the reason to continue and to grow. And when we looked around and said, what do we, I was very clear with you. I said, if you do this with us and we take the commitment, we intend to actually go out and expend it, which we've done, I think, in spades. But the reality is that it was very easy when Jonathan and Chris and I sat down with the rest of the leadership team and said, how do we feel about, re-upping? I think that's probably the biggest compliment I could give you about how you've chosen to define and run the business, right? The same people who were with you at the beginning of the process are there today. I think very much so the same in the reverse. But also the feeling is that we're just sort of scratching the surface at what the partnership could really unleash together is what I think, and again, we were very clear. We weren't counting on any of that when we made the initial decision. But I think that's come to be much more the defining driver. And I am running out of hall passes of calls I can take at any time. When you have a daughter in the business and you have a partner like Chris Ressa, and now you have a partner like Bruce Cohen, I am going to have to figure out how to carve some of that back because I am, as you are, deeply in love with my wife and don't want her pissed off at me. But we'll have to work on that. So we're going to put a wrap here. Thank you so much for taking the time to come to New York and to do this with us and to help us christen the Chris Ressa Retail Retold podcast studio.
My first podcast experience.
I find that absolutely. I had no clue when we sat down that this was your first experience doing a podcast. I mean, I think about, first of all, I've been on with Chris a bunch on Retail Retold, but I've been on lots of people's podcasts, and I've actually the non-CBRE person who's been on their podcast, The Weekly Take, the most. And I had no idea. It's kind of funny, as Chris was in here earlier pre-gaming with us and said, well, what we all do is we talk for a living. And then to hear that you had never been on a podcast before just blew my mind. So we've rectified that hole in your resume. That there was a hole in your resume. Lord help us. The man has probably one of the most extraordinary resumes and careers in commercial real estate. So thank you for joining us. That's a wrap for this week's Retail Retold. I'm Adam Ifshin. I am your guest host this week, sitting in for Chris Ressa. And thank you all for listening. And we hope to see you at a DLC shopping center real soon.
Appreciate you watching. Hit subscribe. See you in the next one.